All right, so this is problem number 3 of the chapter 7 homework on Connect. It's about Joey's bike shop, which sells new and used bicycle parts. Although a majority of its sales are cash sales, it makes a significant amount of credit sales. So credit sales, that's on account, accounts receivable. During year 1, its first year of operations, Joey's bike shop experienced the following. So it gives us different amounts for sales on account, cash sales, collections of its accounts receivable, and then uncollectible accounts that were charged off during the year. So charged off, written off, whatever you want to say. So in part A, it wants us to assume that Joey's bike shop uses the allowance method of accounting for uncollectible accounts, and it estimates that 1% of its sales on account will not be collected. So one thing I want to point out is that the allowance method of accounting is the method that we have been using in the past couple of problems on this homework. It's basically where we have an allowance for doubtful accounts and we make an estimate about the amount of sales that we won't be able to collect that are on account. So basically that estimates that 1% of its sales on account that is a part of the allowance method of accounting. So it asks us, what is the accounts receivable balance at December 31st, year 1? So in order to determine this amount, I want to write out my T account in order to see what that ending balance is going to be for accounts receivable. So I already wrote it out down here at the bottom. So first I did sales on account and debited accounts receivable, $260,000. I went down the line. I said cash sales. Well, that doesn't affect my accounts receivable. That's not on my T account. I had collections of accounts receivable of $235,000. So I credited my accounts receivable, meaning it is decreased because we actually collected some of our accounts receivable in cash. And then also it said that our uncollectible accounts that were charged off during the year totaled $1,250. So that $1,250 was also credited in our accounts receivable account because it made our accounts receivable decrease. So those are the 3 things up there that affect our accounts receivable account for an ending balance of $23,750. So that is the answer that I'm going to put for number 1, $23,750. Next, it is asking us, what is the ending balance of the allowance for doubtful accounts at December 31st, year 1, after all entries and adjusting entries are posted? So that is a key phrase right there. It wants us to make sure that we are going to do the adjusting entry for that estimate of the amount of accounts receivable that we are going to be unable to collect, this 1% of its sales on account. So essentially how we are going to calculate that estimate, because we have to put it in our T account, is we are going to take our sales on account for the year, which in my case was $260,000. And I'm going to multiply that by 1% for a total of $2,600. So this is my estimate for the sales on account that I don't think we are going to be able to collect. So now that will help me when doing my allowance for doubtful accounts T account down here at the bottom. I debited the $1,250 that were charged off during the year that we wrote off of our books that we said we are not going to be able to collect. So I debited that. And then I credited this estimate of $260,000 times the 1%. And I'm not going to make a whole T account for it, but the debit for that estimate would be going to uncollectible accounts expense in this case. So when I total up my T account here, I have an ending balance of $1,350, and I will be writing that up here. Number 2, allowance for doubtful accounts. That is the ending balance for this year. So it asks us now, what is the uncollectible accounts expense? And as I put down here, maybe I should have made a whole T account for it. I said that the debit for this estimate would be to uncollectible accounts expense. So that's that $2,600 that we just calculated. So that is going to be my uncollectible accounts expense for the year. And last but not least, it asks us for the net realizable value of accounts receivable at the end of the year. So we have to remember that net realizable value, that's our accounts receivable minus our allowance for doubtful accounts. So I have both of those amounts right up here. So I'd take the $23,750, subtract the $1,350 from that to get a net realizable value of $22,400 for the year. So that is how we calculate all of those amounts when we are using the allowance method of accounting. Now you'll notice down here in part B, it says we should assume that Joey's Bike Shop uses the direct write-off method of accounting. That's important to note because not all of the amounts are going to be the same when we use the direct write-off method. So essentially the difference between the allowance method and the direct write-off method is that with the direct write-off, there is no allowance for doubtful accounts. When accounts receivable is written off, it's basically we don't do any estimate. Accounts receivable is written off directly to our uncollectible accounts expense once we determine that the account is uncollectible. So there is no estimate. There's no 1% of its sales on account we estimate will not be collected. There's none of that with the direct write-off method. So you'll see that as we go through each of these amounts. So for the accounts receivable, nothing changes because everything in this T account, it was sales on account, our collections of accounts receivable, and the uncollectible accounts that were charged off or written off during the year. So all of that still is applicable under the direct write-off method. Remember, it's just when we do an estimate that doesn't happen under the direct write-off method. So same as in part A, accounts receivable is $23,750 for the year. Our uncollectible accounts expense is where things are a little bit different because as you can see, our uncollectible accounts expense under the allowance method was that estimate of our revenue for the year times that 1% that we thought was going to be uncollectible. Our uncollectible accounts expense under the direct write-off method is going to be just that $1,250 that we charged off during the year because there is no allowance for doubtful accounts. This account doesn't exist. So that journal entry, if we were to write it out, would look like uncollectible accounts expense, debited for $1,250, and then AR would be credited for $1,250. So the difference here is that under the allowance method, allowance for doubtful accounts is what's going to be debited when there's a direct write-off. But under the direct write-off method, uncollectible accounts expense is what is going to be debited. All right. So that makes it so that $1,250 is what we are going to be writing for our uncollectible accounts expense. And then, as you can imagine, the net realizable value up here, our equation was accounts receivable minus allowance for doubtful accounts. Under the direct write-off method, allowance for doubtful accounts doesn't exist. So it's literally just accounts receivable. Same amount. $23,750 because we are directly writing off accounts when we believe that they are going to be uncollectible as opposed to doing an estimate. So the net realizable value is just going to be the same as our accounts receivable. All right, thanks guys.